Welcome back to Investing Talk Podcast.
Today, we're looking at MSAI Multisensor AI Holdings. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, let's start with why MSAI is suddenly, well, everywhere. It seems to be right at the intersection of AI and sensor tech.
That's exactly it. They're in these high-growth areas, specifically providing edge and cloud software.
Software for multi-sensor platforms, right? For the Internet of Things, the IoT market.
Precisely. And the market's reaction has been, well, intense.
Intense is putting it mildly. The price action is unbelievable.
Yeah, the stock surged, what was it, 93.41%.
In just the last week.
Yeah.
And nearly 79% over the past month. That's some serious momentum.
It really is. Reflects strong buying, maybe some FOMO too, but you definitely see investor accumulation.
But we need some context here. This isn't some huge company.
No, not at all. It's important to remember MSAI is a microcap.
Market cap around $33.25 million.
Right, and about 34.5 million shares outstanding.
So tiny, which means leverage.
Huge leverage. Any good news, like a growth surprise, could send it flying, but...
But the risk is equally magnified. Small cap volatility is real.
Absolutely. It's a classic double-edged sword. High potential, high risk.
Okay, so let's dig past the price chart. What about the fundamentals? Is this growth real?
Let's look at the positives first. Revenue growth is actually pretty strong.
How strong are we talking?
They hit $7.4 million in revenue for 2024. That's up 36.32% year over year.
From about $5.4 million in 2023.
Exactly. So that suggests they are gaining traction, market penetration seems successful, demand is growing.
36% growth is solid, no doubt. But does it justify the hype? And what about profitability, or lack thereof?
That's the critical question. They are still losing money, quite a bit actually, but there are maybe some early faint signs of improvement.
Okay.
Well, the net loss improved slightly. It was down 3.47% year over year, coming in at negative $21.5 million for 2024.
Wait, hold on. Negative $21.5 million loss.
Yeah.
On $7.4 million in revenue.
Yep, that's the number.
So they're losing almost $3 for every dollar they bring in. That's a massive burn rate.
It is, and that's the biggest risk factor, no question. This cash burn means future funding rounds are almost inevitable.
Which could mean dilution for current investors.
Potentially, yes. You have to watch that closely. But the market seems willing to overlook it for now. Why?
The technology, I assume. Their competitive edge.
That's the argument. The bulls point to their tech leadership. It's about integrating end-to-end multimodal sensing with AI analytics.
Okay, multimodal sensing. Let's break that down. What does it mean practically?
Think about monitoring something complex, like industrial equipment or critical infrastructure.
Okay.
Instead of just one sensor, like temperature, their platform fuses data from multiple types, temperature, vibration, sound, maybe even visual data, all at the same time.
And the AI part. It processes this fused data.
Right. And crucially, it often does it at the edge, right where the sensors are, not sending everything back to the cloud.
So faster decisions, less data transmission needed.
Exactly. That's vital for industrial IoT, security, potentially defense applications. It creates a defensible niche, they argue.
So the market is betting that this tech advantage justifies the current losses. They're buying future dominance.
That seems to be the thesis. They serve clients both domestically and internationally, so the potential market is large if they can capture it.
It's a big if, though, given the financials. Which brings us back to the cash burn and financial stability.
Which is why the recent capital injection was so important, a major near-term catalyst.
Right. They announced that $14 million private placement in October 2025.
Correct. Specifically for growth capital. And the first part, the first tranche, closed quickly.
That's a good sign. Shows investor confidence, right. Strengthens the balance sheet, funds R&D.
And gives them breathing room. Buys them time to execute.
Speaking of execution, what about leadership? Any specific initiatives?
Yeah. The sources mentioned CEO Asim Akram is pushing new strategies for market penetration and getting products adopted.
And focusing on overseas growth, too.
Yes. Definitely an emphasis on international opportunities. That new capital is meant to fuel those efforts.
And Wall Street seems to be buying into this story.
Overwhelmingly so, it appears. The analyst consensus is a strong buy.
That's pretty rare for a microcap with these kinds of losses.
It is. And they're not just holding ratings, they're raising targets. The average price target was just bumped up to $2.30.
That's a 12.5% increase recently.
And some analysts are even more bullish. We're seeing forecasts stretching towards $2.75.
Wow, okay, $2.75. That's what, almost a 186% premium from where it's been trading recently?
The massive premium, which tells you analysts are expecting some major positive developments.
So what are these expected developments? What are the key catalysts everyone's watching in the near term?
There are a few specific dates and events coming up in the next, say, 3 months that could really move the needle. High potential for volatility around these.
Okay, let's hear them.
First up, November 11th, 2025. That's the Q3 earnings release.
Obviously crucial. Focus will be on revenue, sure, but maybe even more on cost control.
Absolutely. Can they accelerate revenue while showing that operational loss is narrowing significantly? That 3.47% improvement needs to get much better, much faster.
If they miss on costs, even with good revenue, the stock could get hammered.
Very likely. Then, December 1st, 2025. This one's more technical.
What happens then?
Potential MSCI or ETF rebalancing.
How does that impact a tiny stock like MSAI?
Well, if it gets added or its weighting increases in key indexes, index tracking funds are forced to buy shares.
Ah, so it creates automatic demand, technical buying pressure.
Exactly. It can provide a significant, though sometimes temporary, boost and improve liquidity.
Okay, what's next?
January 10th, 2026. That's when we should get public disclosures of institutional buys from the previous quarter.
So we see if the big money, the pension funds, the endowments, are actually stepping in.
Precisely. Seeing large, long-term institutional investors taking positions would be a massive vote of confidence in the whole story. It signals they believe the tech and the long-term plan outweigh the current burn rate.
So those are the concrete dates. What about the more speculative stuff, rumors, market chatter?
Oh, there's plenty of that, too. Especially with high short interest, any of these could spark a squeeze.
Like what?
Well, the loudest buzz is around potential M&A, acquisition talks.
Makes sense. A larger tech player wanting that specialized AI sensing capability.
Right. If a strategic buyer focused on AI or IoT wants that niche, MSAI could be a prime target. That's often the ultimate exit for investors in these types of companies.
What else?
There's also speculation about a major new product launch. Something AI-enabled, aimed at industrial IoT, maybe before the end of the year.
That would be a big test. Show that R&D spending is actually leading to new revenue streams.
Definitely. And tied to the global push, there are rumors about a large potential contract negotiation.
Defense or infrastructure, maybe, in Europe or Asia.
That's the chatter. A big, high-value contract like that would instantly change the financial picture and validate the tech on a global scale.
Okay, so putting it all together. The long-term view. Analysts rate the thesis pretty highly, right? An 8 out of 10.
Yeah, the overall bullish case rests on those long-term industry trends. AI-driven sensing platforms for industrial security infrastructure uses, that market is just getting started.
It's a structural growth story.
Exactly. MSAI offers a way, albeit a risky one, to get early exposure with potentially high leverage to that multi-year expansion.
So, summarizing for listeners, this stock seems to appeal to different types of investors.
I think so. You've got the short-term momentum traders playing the upcoming catalysts, earnings, rebalancing, rumors, potential squeezes.
And then you have the long-term believers focused on the AI and IoT growth narrative, willing to ride out the volatility.
Right. But for both groups, the caveat is huge. Manage the risk. This is a microcap burning cash rapidly.
Meaning tight stop losses for traders and deep conviction plus position sizing for long-term holders.
You absolutely have to respect the volatility inherent in this kind of company.
So execution is everything.
It really is. How they perform in Q3, how they use that new $14 million, whether institutions actually show up in those filings, that's what will shape the near-term path.
And ultimately, product innovation and landing those big contracts are the real keys to unlocking that massive upside potential analysts are pricing in.
Absolutely. So the final thought for you to consider is this. How much execution risk is already baked into MSAI's current price? And can this small team realistically deliver on the kinds of breakthroughs needed to justify that potential 186% premium?